Despite potential disruption from the U.S. government shutdown, U.S. stocks ended at record highs yesterday. Let's get perspective on what to expect as we move further into the fourth quarter. We're joined by Paul Harris, portfolio manager at Harris Douglas Asset Management. Paul, always great to see you. Thanks for joining us.
My pleasure, Andy.
What are your thoughts? Does it still feel like, or does it feel like a toppy market, this? I'm thinking particularly of the U.S.
Yes, I mean, I think if you look at a lot of sort of sentiment indicators, so you know that you could see that they're at very high levels, which is sort of contrary indicators. I think you're also looking at, from an economic point of view, I think one of the issues that we all forget as investors is that the U.S. economy is much more dynamic than sort of the Canadian economy or other economies. And so they were able to, I was really kind of shocked that you wouldn't see some of the tariff impact happening much quicker. But I think it's really because they are much more of a dynamic economy. And I think that also, many of the companies were able to eat some of the costs. But I don't think that can happen for long periods of time, especially kind of on the retail side. So I think what you're going to see in the next couple of quarters and what we should be looking for as investors is, are these companies passing on some of those costs to the end customer? And I don't think you've seen it so far. Maybe a little bit of it, but not a lot of it. And I think that's as their margins are very skinny in a lot of these businesses, and so they can't constantly eat all these tariff costs. So I think that's one of the things we have to look for in the fourth quarter, going into the fourth quarter, and some of the earnings numbers that are coming out in the third quarter. But also you've seen, I think, with a lot of economic numbers, ADP came out, ISM survey, they're all quite negative. The Dallas Fed even talked about sort of on the employment side. I think so the employment side looks to be very weaker than people are expecting. Mm-hmm. And I think the non-farm payrolls numbers that come out later tomorrow may indicate that even further, which only leads to probably, definitely you'll see the Fed reduce rates in the next couple of months. But it also, I think, leads to this issue is that we may see, which is, I think, my fear more than anything else, mm-hmm. in the U.S. economy, a higher inflation but slower growth, which is, as people call it, stagflation. And that's a very tight rope for the Fed to maneuver through. So I think I worry about that, really, because you haven't seen those inflation numbers come through, but you are seeing mm-hmm. indications of slower growth in the United States.
That's interesting that you feel that companies haven't yet started passing on higher costs to customers, but they may have to. And of course, that could stoke inflation. And do you feel there's a sense of complacency in the market right now, Paul, in the sense that the VIX, the volatility index, is very low?
Absolutely. I think there's lots of complacency in the market in that respect, right? I mean, the VIX is very low. It's well below its average. And it's been, in all fairness, it's been well below its average for a long time, but it's well below that average. I mean, you saw that OpenAI, which is probably the most wealthiest startup ever, is raised money. It's a tremendous amount of money over the last little while. It's a $500 billion market cap. I think there's a lot of hype in all these things. So I think you have to be careful. I really felt that, sometimes in September, you tend to see a kind of more volatility, which we didn't see in September. Mm-hmm. But you may see that over the next little while, where you see kind of a culmination of a lot of these things come together that cause more volatility in the stock market. Mm-hmm. It doesn't mean that you shouldn't own stocks. It just means that you should really be aware that, that you may see a pullback, and in that pullback, it may be an opportunity, I think, for investors to buy companies that they really like.
That's interesting. Yeah, you talked about OpenAI. Reuters talked to a source who says a share sale now valuing that company at $500 billion US, OpenAI.
Right. Yeah, it's incredible. Right.
What are there any surprises that are coming in the fourth quarter? Now, you referred already to the risk of price increases by companies in heating up inflation. Is there anything, though, that anything else investors are underestimating or ignoring that's likely to come in the next few months?
Well, I think like I said, the one big risk is that, you do kind of finally see this slowdown in the United States, right? And I think that as you've seen in sort of other slower growth and the implications of many of the things that have happened in the United States, whether it's the tariffs, whether it's the big, beautiful bill, all those things culminate in a economy that slows down. And I think with the high debt levels in the United States and around the world, don't get me wrong, debt around the world is very high as well. Having excessive amount of debt is just shown to slow growth, right? And I think that that's probably what's going to happen. I mean, the funny part about this is that the tariffs are probably generating, I think, if they stay at these levels, about $3 trillion. But if you put that against the debt, that would be very good. But it doesn't sound like they're going to put that against the debt, right? So I think that this issue that debt continues to rise globally will have an impact, I think, around the world. And I think it's something that we should be aware of. And one of the things I think people forget is a lot of the bad things that happen in the stock market is actually caused because of the debt market. The debt market is the part where everything happens, and then it's sort of occurs in the stock market where people have much more visualization of the stock market than the debt market. People see the stock market every day. If you walk down the street in Toronto or wherever, you can see all the so you don't see that in the debt market, and the debt market has a much greater impact overall, I think, than so people are, so I think one of the issues that I get worried about is that we're moving into a world of very excessive amount of debt. And if you are the Fed and you can't drop rates as quickly as people think, you're paying a lot of interest on your debt, and the debt continues to increase, right? So I get worried that we're not being fiscally responsible anymore. And I think that's a really bad thing for economies around the world.
The debt market. I mean, there's vastly more money in the debt market. And you and others, I think, are making the point, you may have touched on this already, that there's a sense of don't worry, be happy in the debt market, in that junk bonds trading at very narrow spreads to investment grade. So it seems like there's a sense of optimism there, too.
Yeah, so I mean, one would argue that that's a lot of complacency, right? So one is that you're seeing corporate spreads on the investment grade side be very, very tight, tightest they've ever been in maybe 50 or 60 years. The same thing on the high yield debt side, and so I think there's and that probably leads, which is one of the big issues, is the covenants end up being weaker and weaker because people can get away with all this, or corporations can get away with all this stuff. So I think that's one of the other issues that you have to worry about is covenants on debt ends up being weaker and weaker. And you've seen also a lot of people move into, which I think is, obviously riskier in some ways, is private debt markets and all these other things. And I think that, and then the other thing I think, which is very terrible, is that you've seen a lot of these private equity, private debt companies want to be able to access the retail environment in the United States and Canada with these products, which I think will be in the end very detrimental because they're very illiquid, and they lock you in for long periods of time, like you've seen with a lot of the real estate products that have happened where they were yielding very high yields, and now those yields have fallen and most people can't get their money out. So I think that we're in a world where these things are seen to be better than being in stocks or bonds, but they're not liquid, right?
Yeah, it's interesting. We've seen a couple of private equity mortgage funds and the like freezing investors' money. I see their Kensington Capital Advisors in Canada has suspended redemptions of units. So, it had assets as at the end of June of almost $2 billion. And it's an affiliate of AGF Management. So that's a private equity fund freezing investors.
Yeah, I mean, I think this is the problem, right? Like, I mean, if you're putting money into those things, you have to have a very, very long time horizon, and you can't get your money out. You're stuck, right? In all fairness, these things are written, like their prospectuses are written this way to be able to manage through these periods. But as a retail investor, I would argue that most of them don't read the prospectus.
Yeah, I like that. They're temporarily reducing the management fee. Yeah.
Maybe. But, I mean, I don't know how much they're reducing the management fee by on that thing, but they're probably still making 2 and 20 or whatever they make, and they've probably gone down to 1.5 or something. The problem is the people who manage it still get their money, and the people who invested don't get their money, right? So either way you slice it, that's not good.
Yeah, they're cutting the management fee by 1/10 of 1%. I would say, while you're freezing my money, I don't want you getting any management fee. But anyway, I'm not sure. I think we're out of time, Paul. We better leave it there. Thanks very much.
Thank you very much.
Paul Harris,
My pleasure.
Portfolio Manager at Harris Douglas Asset Management.